This week on the Business Owner's Corner, I'd like to talk for a minute or two about how to take money out of your health savings account tax-free. Health savings accounts, or HSAs, are a great way for a lot of people around the US to save for their future medical expenses. They're not a good fit for everybody, but if you're eligible for one, it's a really good idea to contribute to them. You're only eligible for them in the first place if you have what's called a high deductible health plan, which is defined this year as having a health plan at the individual level with a deductible of $1,400 or higher. If you have a family plan, that deductible needs to be at least twice that, or 2,800 bucks. If you have a plan, a health plan with a deductible of those levels or greater this year, you're eligible to contribute to an HSA. You might work somewhere that where you have employers that put money into an HSA on your behalf, maybe give you the opportunity to put money in. If you have a high deductible health plan, but your employer doesn't put money in, or you don't have an employer, you're eligible to fund one on your own. The deal is, when you put money into these plans, you don't pay income tax on it. It's a deduction. It's a deductible contribution. You put money into the account, you can invest those dollars. All the potential investment growth in the account is tax deferred, tax exempt really. And then down the road, when it's time to take money out of the account, it comes out tax free if it's for a qualified medical expense. So in today's video, I want to cover the logistics of how this actually works. Let's say that you have an HSA with money in it. You want to take it out tax free. The way it works is you might have a debit card for the HSA. You might not. You have two ways that you can take the money out. Either you can pay your expenses directly from the HSA. So if you have a debit card, you go to the doctor, they want you to pay a copay. You can use that debit card at the doctor's office. It comes directly out of the account. The second method is you go to the doctor's office, you pay out of pocket with cash or your own credit card or whatever, and then you have your HSA take money out to reimburse you for that expense later on. Logistically, it really doesn't matter, because when money comes out of your HSA, that triggers the custodian of the HSA to send you a 1099 at the end of the year. Technically, it's Form 1099 SA. They send one copy to you, they send one copy to the IRS, notifying them that there was a distribution from your account. You're expected to report on that distribution when you file your taxes for the year. It's on Form 8889. And when you file the form, you're reporting to the IRS how much money is on that 1099, how much came out of your account, and how much of that distribution is either a rollover in between HSAs or for qualified versus non-qualified medical expenses. So the way that you take money out of the account tax-free, you have a choice. You can pay your medical expenses directly using the debit card they give you, or you can pay them out of pocket and have the HSA reimburse you. Now, what's a qualified expense? What's a non-qualified expense? It's any healthcare expense. In some circumstances, you can pay medical insurance premiums with your HSA. In other circumstances, you can't. It does not include a hot tub, for example. It doesn't include a new bike or exercise equipment. It has to be for qualified medical expenses, and there's guidance on the IRS website if you need some specifics about what that is. Now, let's say that you stretch the rules a little bit. You say, hey, I've got 10,000 bucks in the HSA. I want to go buy a hot tub. So you take the $10,000 out of the HSA. The IRS does not think that's a qualified medical expense, but you take the 10,000 bucks out, you buy the hot tub anyway. Well, you're going to get a 1099 at the end of the year. And on that 1099, or on the 8889, the form you file with your tax return reporting where that money came from and whether it was a qualified expense, you fill out that form. And if you're arguing that the hot tub is a qualified medical expense, then when you submit the form, it's not, the $10,000 is not going to incur any penalty or additional taxation. And you file the return and just kind of hope that you don't get audited. Because if your return does get pulled for audit, the auditors will look at that form. They'll want to see receipts for what the expense actually was. and they're going to win the argument that it was not a qualified medical expense. Now, let's say that you have $10,000 of surgery, and you take the money out of your HSA to pay that expense with. It's a qualified medical expense. You have all the receipts and so forth. You report it as a qualified medical expense on Form 8889. You take the $10,000 out. It comes out tax-free. You don't incur any additional tax or penalty. Back to the hot tub. You take the 10,000 bucks out, you buy a hot tub, but you know it's not a qualified expense, so you report it as such on Form 8889. The $10,000 that you took out counts toward your taxable income. You have to pay tax on that. And if you're in the 24% federal bracket, that means that you have to pay 2,400 bucks to the IRS when you file your taxes for the year. On top of that, there's an early withdrawal penalty if you're younger than age 65. If you're over 60, if you're 65 or older, you can take the money out without penalty, but you do pay income tax on it for non-qualified expenses. If you're under 65, you pay tax on the distribution plus a 20% early withdrawal penalty. So if you take the $10,000 out of your HSA to go buy the hot tub, you report it as a non-qualified medical expense. You're paying, if you're in the 24% bracket, 24% on that $10,000 plus the 20% early withdrawal penalty. So to get the money out of your HSA for a non-qualified expense, you're paying $4,400 to the IRS to do that. So the rule of thumb here is allow the assets in your HSA to continue growing until you might need them later. If you're 40 and you think you want to buy a hot tub, try to use other assets because you probably will have future medical expenses in your life at some point. You might as well leave the money in that account until they pop up and you have a good, valid argument to take them out down the road. Now, here's a pro tip. If you have an HSA and you want to take money, you think you want to take money out in the future, but you don't really have any need to today, when you do go see the doctor today, try to pay those expenses out of pocket now. Don't use the HSA money. Allow it to continue growing tax-free in the account, but save the receipt. Let's say that you're 40 years old today, you go see your doctor, you have a $50 copay, save the receipt. Because when you're 60, if you want to take money out of the account then, or let's say 65, you take money out of the account, you don't have any medical expenses then, but you do have medical expenses from prior years. And there's no statute of limitations surrounding the time period between the date at which the qualified expense occurred and the date at which money actually came out of the account that you're reporting on Form 8889. So all you need to do is pay those expenses as they come up out of pocket, keep the receipts, and that's your argument for taking money out of the account tax-free, potentially down the road.